The salvage value, or the money we receive when we sell an asset, to be more precise, it's the after-tax salvage value, as we are going to be calling it soon. It depends on two things. Market sale price, so that's basically the price that some buyer pays you, but it's not just that, it also depends on the book value at the time of sale. Let's see how the two are related to each other. So when a firm buys a physical asset, the purchase price that it pays for it becomes its initial book value. So the initial book value, or the original purchase price, is sort of the highest point on the how the value of an asset changes over time. And the value changing over time reflects, the wear and tear, right? The asset getting older, losing its value. So according to the IRS, depreciation is, how much value is lost. And it's considered to be an income tax deduction that allows a taxpayer to recover the cost or other basis of certain property. Then, as the IRS.gov website continues, it is an annual allowance for the wear and tear, deterioration of the property. Most types of tangible property, except for land, such as buildings, machinery, vehicles, furniture, and equipment, are depreciable. Likewise, certain intangible property, such as patents, copyrights, and computer software, is depreciable as well. So, annual depreciation is how much value is lost for that specific year. And according to the IRS, regulations, that amount can be treated as an income tax deduction. So it can be tax deducted. What this means is our taxable income on which we pay taxes is lowered by the amount of the annual depreciation in that year. So we treat it as an expense in an income statement for that specific year. What happens next? 1 year goes by, we see some depreciation, right? The asset has lost some of its value. The second year goes by, more value is lost. So as the firm uses the asset for business, over the years, the accumulated depreciation increases. And because of that, the remaining book value decreases. And we can say that at any point of time, we can calculate how much the asset is still worth, or the remaining book value. And that equals the original purchase price, which by default is the initial book value, minus the accumulated depreciation since the time the asset was purchased. Okay, so let's say another year goes by and another year goes by, so maybe 4 years went by since the purchase, right? The firm eventually decides to sell the asset. How much money will it get back? It will get the amount of money that we call the after-tax salvage value. Sometimes we call it salvage value, but we really mean the after-tax salvage value. And this amount of money that we get to put in our pocket directly depends on the remaining book value. The after-tax salvage value may actually be pretty simple, just exactly equal to the sale price. However, it may end up being less than the sale price or higher than the sale price. So let's look at these two situations, below or above the sale price. When do we get more than the sale price? We put more money in our pocket than how much some buyer pays to us whenever the remaining book value at the time of sale is more than the price at which we are selling the asset. So you can imagine the initial book value being our starting point, and then we sort of like walking downstairs, and each step that we make is the lost value or the depreciation amount. So if at the time of sale the remaining book value is above the sale price, this is the situation in which you are going to be looking at tax savings or a tax refund to you from the IRS. Why? Because you're getting a tax refund because you have been overpaying taxes over time. How do you know that this is what's happening? Well, when the remaining book value is high at the time of sale, it means that as if the asset has not been losing enough value, right? Since the time it was purchased. Because now somebody is only willing us to pay this much money, which is below how much the asset is worth on the books, right? So it's like it's really worth less than what accountants have calculated. So because the depreciation appears to have been too low each year, it means that our taxable income must have been too high over the last years. And a high taxable income means that we have been paying too much in taxes to the government. And so now it's time to get a tax refund. And so the sale proceeds, or the after-tax salvage value, when the tax refund is considered, will equal how much some buyer is paying us, or the sale price, plus the whole tax savings amount, which is calculated by looking at the difference between the remaining book value and the sale price and multiplying that dollar difference by the tax rate which is given to us. The opposite situation is when we will sell the asset used for some amount of money that some buyer will be paying us. However, we are not going to be able to put all of that in our pocket. So the firm will get back less than the sale price if the remaining book value is below the sale price. And exactly the opposite explanation can be presented to explain what's going on, why we are going to have a so-called tax liability. We are going to have a tax liability because this situation implies that we have been underpaying taxes over time. So the intuition is the remaining book value is lower than the sale price because, so essentially it's as if we're trying to sell the asset at a profit, right? So we are going to be taxed on that amount, the profit amount. But you can also say something like the following. You can say that it's as if the depreciation has been way too high. On the books, the asset is worth very little, whereas buyers are willing to pay a good price for it. So if the depreciation has been way too high, then you have been deducting too much money from your taxable income, right? And that implies that you have been paying very little money in taxes to the government. So now it's the time for you to pay some underpaid taxes back to the IRS. The formula that we will use to calculate the sale proceeds or the after-tax salvage value that considers this tax liability is actually very similar to what we had for the opposite case with the tax savings. Here, we are going to end up putting less than the sale price in our pocket. And how much less? That's the tax liability. The tax liability is calculated by looking at by how much the selling price exceeds the remaining book value and taking that dollar amount and multiplying by the tax rate. So what you get is how much would need to be subtracted from the sale price and paid to the IRS. And after that, what's left is your sale proceeds and what you can put in your pocket.